Dividend investing has become more and more popular among private investors like us because we all have the dream of getting paid for doing nothing. Jokes aside, many of us are constantly on the pursuit of passive income ideas, and dividend investing is definitely one of them because it allows you to receive a regular income stream from your stock investments. But is it the right strategy for you to invest in the stock market? Let's find out together. Hey friends, welcome back to the channel. My name is Rick, the Italian guy who went to Germany, and in this video we're going to discuss the 10 pros and cons of dividend investing and dividend stock. If you believe you have any trouble picking stocks, or if you don't know which company to invest in, then be sure to stick to the end because I'm also gonna give you a final tip about that. But first, let me define dividends and dividend stock to get us started. So what is a dividend? A dividend is something of value, usually cash, but not always that, which is given from a company to its shareholders, namely to everyone who owns shares of that company. So if you open an account on a trading app and you buy stocks of a company with it, then you officially become a small shareholder of that company. And if the company pays dividends, then you will also receive them periodically. Dividend investment is one of the many different types of investment strategies, and it basically just means to invest in companies that pay out dividends. So if you use this strategy, you should always have a long-term buy and hold investment approach. Basically, you buy and keep your stocks ideally forever. This is because, in my opinion, dividends only make sense in two cases. One, if you want to reinvest them and grow your portfolio in the long term, and two, if you're rich enough and the stocks you possess can already finance your financial freedom. So what I want to say is this: the average dividend yield on companies listed in the S&P 500 index was historically somewhere between 2 and 5%. So let's assume that you have $50,000, which is a lot for many people, invested in the stock market, in particular in dividend stocks. What you get per year is something around $1,000 to $2,500, which is not the world. That's why I said at the beginning, if you're not rich, it just makes sense to invest in dividend stocks, not because you want to have a cash flow every day to buy champagne and cars, but because you want to use these dividends to reinvest them in the stock market and make use of compound interest to grow your portfolio in the long term. Now, I personally don't possess a lot of dividend stocks, but I do believe that there are certain advantages that may be appropriate for some investors, depending on your investment philosophy and your long-term goals. So now, let's move on to the 10 pros and cons of dividend investing, starting from the advantages. Coming in at number 5, we have preferential tax treatment. Dividends receive a favorable tax treatment compared to your ordinary income. Generally speaking, in the US, the tax rate on dividends is around 15–20%, depending of course on your taxable income and your filing status. In Germany, where I live, there is a flat tax rate of 25% plus solidarity surcharge. So yes, Germany's tax rate sucks. Unlike dividends, your personal income from a normal job is going to be taxed in some cases over 40%, especially if you consider the social security tax. So this preferential tax treatment of around 15–20% for dividend is actually an advantage, but you have to consider two things. One, even the sale of stocks is taxed in the USA with around 15–20% and in Germany with 25%. So it's really not about the dividends, it's about the stock market compared to a normal job. And two, usually the money you use to invest in dividend stocks is derived from your normal job. So it was already taxed with an income tax before. So it's somehow kind of like you pay two taxes on your dividends. Coming in at number 4, we have hedge against inflation. Just as all other investments in general, when well done, dividend stocks can provide a hedge against inflation. If you don't know what that is, inflation is the increase in prices for all the goods and services that we consume, causing our currency, the dollar or the euro, to lose intrinsic value. If you look at the last 120 years, the market has been dominated by inflation, except for some rare cases of deflation. Since it's typical for a company to increase their dividends regularly, then dividend stocks can hedge or offset inflation. So when the prices for goods and services rise due to the inflation, so do our dividends. And instead of losing money because we kept it in the bank, we gain money because we get more dividends. Coming in at number 3, passive income stream with many options. If you own shares of a company that distributes dividends, then the cash is paid out to you periodically and it's there at your disposal, as opposed of the value of your portfolio itself, which can only be unlocked if you sell the stock. The dividends you received are liquidity and you can spend them as you please. You can spend them on a new PlayStation, you can save it for a rainy day, or you can reinvest them on new stocks. Number 2, reduced risk. Companies that pay dividends tend to be more mature and stable than companies that don't. High-risk companies or startups rarely pay dividends because they blow back all their profits to fuel their growth. For this reason, you can usually enjoy a reduced risk because dividend stocks are usually mature companies with less risk of bankruptcy or to lose value and therefore show less volatility in their stock price. This is of course a big advantage above all during bear markets, where the price of high risk and high growth stocks can fall by more than 50%. And number 1, we have dividend growth compounding. As I mentioned before, when you receive your dividends, one option that you have is to reinvest them. When you decide to make a plan of reinvesting your dividends, you're basically doing the so-called DRIP, Dividend Reinvestment Plan. In doing so, you have a double advantage. The dividends that you reinvest are going to add up to your portfolio, increasing its value. And if you've chosen the company correctly, then also the stock price will increase due to the growth of the company. So you basically have a growth that is fueled by 2 factors. 1, the reinvestment of your dividends, and 2, the growth of the company itself. This is in turn going to increase 2 things: the value of your portfolio itself and the value of the dividends that you'll receive in the future, because the dividends are always calculated as a fixed percentage of the value of the stock that you possess. Okay, these were in my opinion the 5 advantages of dividend stocks. Let's go now through the 5 disadvantages. I personally invest more in growth stock than dividend stock, but I do believe that the optimum lies in the middle. I think that a stock portfolio should be adequately diversified, and that also means possessing shares of some mature companies that pay dividends and some shares of some risky companies that don't. So now let's go through the 5 disadvantages of dividend investing, coming in at number 5, double taxation. Now, we already discussed the preferential tax treatment of dividends compared to the income of regular jobs. But if you compare dividend stocks and growth stocks, there is also another side of the medal that you can't ignore. Dividends are taxed twice. It's really called double taxation. If a company decides to pay out dividends, then the earnings of the company are first taxed at the company's year end. The second taxation comes to you. When you get your dividends, you pay this 15 to 20% tax that we talked about before. On the other hand, a growth company doesn't distribute dividends. Instead, they decide to reinvest their earnings in the same fiscal year into the business growth. So this way the company can avoid paying taxes on their earnings, and you can also avoid paying income tax if you hold on to your stocks and you don't sell them. Number 4, dividend policy changes. Usually, you can predict a future dividend payout of a company based on the payouts of the past. But a history of dividend payouts is not a guarantee of dividend payouts in the future. Usually, companies that pay dividends pay them and increase them regularly, but in some cases they might have better uses for the cash and decide to reduce or eliminate the dividends. So the management can decide to change the dividend policy, and this can be very harmful to dividend investors. Not only as a dividend investor, you could suffer a drop in your future passive income, but also since many other dividend investors bought the same stock, they could also be disappointed like you, and a big sellout could lead to a drop in the share price of the stock. Coming in at number 3, a lame compound interest. The compound interest is a concept for which if you invest in something that grows at a certain percentage per year, then the value of what you possess increases slowly at the beginning and then faster and faster as the years go by, because it grows in an exponential fashion. This makes investing in the stock market much more useful if you buy and hold on to your stocks for a long period of time. If you don't sell anything, if you hold on to your stocks, as we said, then you don't pay taxes. So you can potentially grow your portfolio tax-free as long as you don't sell and make maximum use of compound interest. But this is not possible with dividends because the dividends are taxed at the source. So even if you decide to reinvest your dividends every time to increase your portfolio, the value of your portfolio is every time reduced by the value of the tax that you pay on your dividends. Number 2, mature low growth companies. Most growth companies, namely companies that focus on a strong, rapid growth, don't give dividends because they decide to reinvest all their profits into the business expansion. On the other side, mature companies often don't have opportunities to expand, and hence they offer a large profit to the shareholders. So when you invest in dividend stocks, in most cases you're investing in companies that may not give you high returns in the future. Some investors are okay with the slow growth of their portfolio due to dividend stocks because it's safer. But be careful, because these investors in most cases didn't make money thanks to dividends. They made money thanks to other business of theirs, and then they decided to invest in dividend stocks because they wanted a safe passive income source. And coming in at number 1, my favorite, Buffett doesn't agree. Warren Buffett is kind of like the Buddha of finance, and whenever he says something, everybody listens, and listens carefully. So since shareholders have to pay income tax on their dividends, Buffett has never been so fond of using them. Another trick that he prefers is when companies use their excess money to buy back their shares or to invest them back into growing their business. Berkshire Hathaway, Buffett's investing company, never paid dividends and always kept 100% as return earnings. If you are young, chances are you don't need passive income at this stage, so the payment of dividends only means that you have to find a way to reinvest them again. So if the company retains their earnings and invest them for you, then they're making the decision for you and you don't have to decide where to allocate your money. So let's wrap up now the benefits and the disadvantages of dividend investing. The benefits of dividend investing are preferential tax treatment, hedge against inflation, passive income source with many options, reduced risk, and dividend growth compounding. While the disadvantages of dividend investing are double taxation, dividend policy changes, a lame compound interest, mature low growth companies, and Buffett doesn't agree. Finally, as I said at the beginning, I'd like to give you a tip if you want to be a dividend investor, but still you don't know how to analyze a stock or a company, or you don't want to have the trouble of picking stocks. You can still invest in dividend stocks by using exchange traded funds, the so-called ETFs. I'm gonna talk in details about ETFs in future videos because I do believe that they deserve much more time and consideration. But basically, an ETF is a package that contains many companies inside it, even hundreds or thousands. When you buy an ETF, you basically own shares of all the companies inside the ETF. So the advantage is that if you pick a stock, the company could go well or could go wrong, and it's up to you. But if you buy an ETF that follows an index, the average growth of all the companies inside the ETF is probably going to be a positive one in the future. Alright, that was my list of my top advantages and disadvantages of dividend investing. I really hope you liked it. If you did, write down in the comment section below if you are a dividend investor or if you prefer to invest in growth companies. In my humble opinion, I do believe that the younger you are, the more you should invest in growth companies because they have a lot of potential for the future, and you still have the time in the future to shift from growth to dividend stocks. And if you think about it, if you don't have something in the range of $300,000 to $1 million, it's not like you can make a living out of your dividends. So anyway, it's up to you. I think a balanced portfolio is the better choice. I think just that at the beginning you could push more in the direction of growth, and then the bigger your portfolio in the future, the more you can move to dividends, stocks that are safe and guarantee you a passive income. So if you like this content, please don't forget to subscribe to my channel and smash the like button. It's a small gesture and it's free, but it really helps me a lot to grow my channel. So be a good buddy and help a friend. Other than this, I really hope you liked it. I wish you a great evening and I'll see you in the next video. Ciao!